Hi, I'm Keith Quinn, the Director of Investments for Shoemaker Financial, with our first economic update for the year of our Lord 2017. In this update, we'll take a look at how we finished last year as well as the current economic environment. Hopefully we can provide you some insight into what all this means for you as an investor. Looking back, it's really amazing how the markets reacted after the presidential election. Since the election on November 8th, we've gone on to set multiple new highs in the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite. And while the markets cooled off in the last few weeks of December, 2016 turned out better than expected, with the S&P 500 gaining 12%, the Dow Jones Industrial Average up 16%, and the NASDAQ Composite gaining 9%. However, when we look internationally, given the uncertainty around Brexit and questions about the continued viability of the European Union, international equities once again lag behind the U.S., with the MSCI EFA, which tracks international stocks in developed countries like those in Europe, gaining only 1.5%. So why did U.S. stocks perform so well after the election? Well, at least one reason was a dramatic jump in optimism about the direction of the U.S. economy. In fact, the percentage of Americans who believe the economy will get better this year gained an unprecedented 17 points, climbing to 42%. Now, as we've said before, there are definitely some reasons to be optimistic that a unified government under a Republican president could actually make some real progress on things like tax cuts, repatriating corporate profits, regulatory reform, and an increase in infrastructure spending. And after the sluggish plow horse economy we've experienced since the Great Recession, any glimmer of hope is most welcome. However, as long-term investors, remember, we don't get caught up in the noise, whether it's good or bad. And just because U.S. stocks are setting new highs on what can sometimes seem like a daily basis, that is not a reason to alter your allocation and try and chase the rally. Apart from the potential impact of the election, there are also other reasons to be hopeful about the direction of the economy. For instance, the final revision to third quarter GDP showed the economy growing at a faster than expected 3.5%. And along with the increase in GDP, the employment picture continues to improve, with the unemployment rate hovering around 4.7%, which, when you couple that with a growth in average hourly earnings of 2.9% over the last year, means that the labor market is fast approaching full employment. Furthermore, growth in personal income has been showing signs of strength in recent months, all of which goes to tell us that Americans have more money in their pockets and should increase their spending accordingly. And since consumer spending accounts for more than 2/3 of GDP, the combination of stronger employment, wages, and spending could help advance our economy at an even faster pace and continue to provide a boost to GDP growth. Lastly, let's touch on interest rates. As we anticipated, the Federal Reserve voted unanimously to raise the overnight lending rate by 25 basis points at their meeting in December. In support of their decision, they noted the improvement in the jobs market, the drop in the unemployment rate to pre-recession levels, and the pickup in inflation. However, they did raise the forecast for the number of potential rate hikes this year from 2 to 3. But fortunately, the markets and the economy finally seem poised to withstand a move back towards a more normalized interest rate environment. So all in all, given the improving economy and the recent market performance, we have a lot to be thankful for as we enter the new year. But don't forget, as investors and not traders, we're in this for the long haul, so don't get too caught up in the optimism. And always keep in mind, if your goals haven't changed and how long you have to reach those goals haven't changed, the allocation of your portfolio probably shouldn't change either. Well, that's it for this month's update, and please remember that nothing we talk about here should be taken as a recommendation. If you would like to discuss your personal financial situation in more detail, please don't hesitate to reach out to your advisor, or you can always give our office a call at 1-800-757-1059. Until next time, I'm Keith Quinn for Shoemaker Financial, wishing you continued peace and prosperity and a very, very happy new year.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. This material represents an assessment of the market environment at a specific point in time and is not intended to be a forecast of future events or a guarantee of future results. The S&P 500 index is an unmanaged index generally representative of the U.S. stock market. The Dow Jones Industrial Average is a widely followed measurement of the stock market. The average is comprised of 30 stocks that represent leading companies in major industries. These stocks, widely held by both individual and institutional investors, are considered to be all blue-chip companies. The NASDAQ Composite is a market value weighted index of all common stocks listed on the NASDAQ exchange and is comprised primarily of technology stocks. It is not possible to invest directly in an index. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Past performance is not indicative of future results. This material has been provided through the research of Platinum Advisor. Keith Quinn is a registered representative and investment advisor representative of Securian Financial Services Incorporated, securities dealer member FINRA SIPC, a registered investment advisor. Shoemaker Financial is independently owned and operated.